Get started with today's class. A little late start, but that's okay. It gives me some extra time. So last time we really just built our first portfolio. We kind of looked at how we take all of these different concepts that we talked about, looking from stage 1 to stage 3 on a time basis, and from level 1 to level 3 on a diversification basis and an exposure risk basis. We kind of took those concepts and we started applying them and building a basic portfolio. I want to stress again, any of these numbers you see here are really it's like a jumping off point. It's not something that's going to be perfect for your situation. It's not going to be perfect for every situation. This just happens to build, with the funds that I picked, a portfolio that somewhat matches the risk tolerance that I was going for. And again, we can spend a lot of time going from that base, replacing funds, adding funds, moving funds around, changing allocation sizes. There's a lot of tweaking that we can do to get from the simple sample that we built all the way towards something custom built for a particular person. But I just put these here so that if you have literally no idea where to start or literally no idea how to evaluate, you might have some sort of guideline to look between. So we came up with our sample portfolio that you can see on screen here, and it ends up being a pretty inexpensive portfolio at about 16 basis points, a basis point being a percent of a percent, and a standard deviation of about 11% over the last 3 years. This data was calculated the last time we did this class, so it might be a little bit different today, but it should be roughly the same, somewhat similar to what you might see in a balanced portfolio. So again, the things to remember from all that stuff that we talked about is that each portfolio will take on a different form based on its purpose. If you have a growth account that's just for your kids, it's probably not going to have any cash reserves. If you have an account that you're relying on for your retirement income, it's probably going to be more conservative. If you have an account that only has a time horizon of 1 year, you're probably not going to have any equity funds in that, because what would have been the point if they went down in that period? A portfolio can be as simple or as complex as you'd like, but regardless of how many funds you have, retain diversification. So really what I'm saying in that is we bias towards having lots of positions because it gives us lots of control. If I have 10 different funds to pick from and they all do different things and I have some particular need that I need to fulfill, there might be one of those funds that fulfills that need better than another. But that's not to say that you couldn't have a very simple, very low fund count portfolio that's still diversified. For example, if I were to have an account that is simply a total market equity fund and a total market bond fund, I'm still diversified on a fundamental level. I'm still diversified across a lot of different investments within those funds. I'm not diversified in terms of positions. I can't pick and choose what types of areas of the stock market I'm getting in and out of, but I am still having a very large basis of underlying holdings that give me sort of a more averaged out return and is less exposed to the risks that you could diversify away that we talked about. Things like a particular company doing really poorly, or a particular bond defaulting, or any of those sorts of really specific risks. So no matter how small your portfolio is or how few funds you have in it, make sure that you have the diversification to take care of those things. So even if you only have 2 or 3 funds, make sure that those 2 funds are spread out in their underlying holdings. That way you're not, putting yourself up to just absolutely ridiculous levels of risk that you don't need to be taking, unless that's your goal, in which case, have fun. Bias your holdings towards low-cost investments. Fees can be a really big detriment to performance, even with good performing funds. If we just call back to the thing I was just talking about with those A-share accounts, if I were to look at that and offer somebody an A-share account where they're paying 54 basis points for an S&P 500 fund versus the probably 2 or 3 basis point S&P fund that I could get them in a regular brokerage account, even if you add up the extra account fees that ends up having to pay, taking 0.5% away from every single year's worth of performance is not worth it to me if all I'm doing is mirroring another fund that's cheaper. So when you're looking at investments, especially when they're expensive, look around and see if you find something that is very similar but is cheaper, because you don't want to just give away money to fees for no reason. Now, if you're handing over fees for a purpose that's different, for example, you could ask why would it be any justification for me to charge a fee to put you in low fee investments? And that would not be because that I can get your returns to outpace my fee, or I can do anything different that somebody else would not be able to do with the knowledge that I have, but it's the fact that I would know you and know how to create a portfolio that fits your need and take away the need or necessity for you to have to learn that skill. So that's kind of where you want to determine where you're handing over your fee. Is you can hand over your fee for something you don't know how to do, or hand over your fee for something that somebody is doing better than you. So that's kind of the two parts where you want to be looking for, when you're spending that extra money, make sure there's a justification for it, even when it comes to a professional like us. So today what we're going to do is we're going to start talking about things that you can use to actually evaluate specific funds and portfolios, stocks, whatever it is you really want. And this will actually help with how you can decide between two funds. And this will just be a really tiny little snippet of what we're going to talk about in a second. But when I was just saying how you could look for a fund that's very similar, that's cheaper. For example, if we look at something like R squared, which is basically meant to convey how similar is thing A to the benchmark, or whatever it is that we would normally compare this to. And if it's 95% similar to this overall benchmark, but I'm paying them like 2% a year to just do basically the same thing that everybody else is doing, that wouldn't make any sense. So that would be one of those things that I would use to kind of figure out whether it is I'm getting value for my money. But we'll get into that, and I'll show you how that actually works in just a second. So evaluating investments with Morningstar is something that we do a lot. That's our primary method of looking at investments and portfolios, and especially how we evaluate people who have portfolios existing, or people who have portfolios with us, or people or proposals that we're looking to create, or give us a guideline of the direction that we're going. So Morningstar provides a very comprehensive, in-depth look at investment products to help us choose assets for our portfolios and to evaluate our portfolios themselves. There are several metrics we can use to evaluate both individual assets and investment portfolios. And today we're only going to talk about a few. There's a lot of extra things in these reports that you could use, things that fundamental analysts like to use, like price to earnings, price to book, but those things are not necessarily my concern. I'm not necessarily looking to pick the best company or the best this. I'm looking to find a particular kind of exposure for a fair fee and to make sure that it fits the objectives of what I'm searching for. So I'll show you how we can use these metrics to confirm that what we're looking at is actually what we want. So firstly, all of the things, the first three things that we're going to talk about are derived from something called modern portfolio theory. And this was something developed by a man by the name of Harry Markowitz. And he was a very, very, it was really statistician when it comes down to it. A lot of these studies were done on taking return data from old investment performance, things like the Dow Jones and the S&P, and being able to put all of these returns together and create statistical measures of relative risk and all of these other different things. So the modern portfolio theory is a practical method for selecting investments to maximize their overall returns within an acceptable level of risk. What this is really saying, I guess, this mathematical framework is used to build a portfolio of investments that maximize the amount of expected return for the collective given level of risk. Okay, I want to focus on just that last part right there. Maximize the amount of expected return for the collective given level of risk. This really comes down to what we're trying to do. Because what we're trying to do is take on a certain level of risk, but at the same time, make sure that we're getting the most return for that level of risk we're taking. I can take the same level of risk 3 different times and get 3 different results. I could get a really high return, I could get a fairly standard return, or I could get a low or negative return. I would prefer to bias towards the opportunities that would more often than not give me a positive return relative to that amount of risk that I've taken on. Because if I'm not getting a positive return, or I'm getting a worse return than I could in a less risky asset,
Why am I here? What's the purpose of me being in this? I want to be in something that's paying off the amount of risk I'm taking, so that even if I have bad years, even if I have a bad decade, or hopefully not, but even if I have really bad periods of time, over time with more data, we hope that it pays off. So that's what these measurements really help us do, is they give us information on each piece of the statistics about the investments that we can use to hopefully massage our portfolio in a way to where, regardless of what level of risk that we're taking, we're maximizing the level of return that that risk provides in the darkest. And a lot of this gets really complicated. So if you don't understand these things fully on the first try, that's okay. There's a lot of really good information out there. A lot of good YouTube videos. And Investopedia.com is what I use for a lot of my definitions here, because they're relatively simple, but they do also allow you to dig a little deeper into the definitions. So we're going to begin with some of the MPT, or Modern Portfolio Theory statistics, that you'll find on Morningstar Report. There are plenty of statistics. There are a bunch of different ways that we can measure things, but I want to focus on the things that are the most easy to understand and are the most easy to apply, and the things that I use and apply when I'm building. So the first thing, which I think is probably one of the easiest concepts to understand, is beta. We've talked about beta a few times, but we've never really drilled down to what exactly it means and how exactly it's derived. So beta is a measure of volatility or systematic risk, and if you remember, systematic risk is essentially just referring to the risk of being in the market, the risk of fluctuations, price fluctuations as we move forward in time, of a security or portfolio compared to the market as a whole, or a benchmark. It can be done either way, but the most standard way is to compare against the overall market, usually using the S&P 500 as a benchmark. Some places might use the New York Stock Exchange Composite as a benchmark. Some might use the Wilshire 5000 as a benchmark. But if it doesn't say, or you're just not sure, you can kind of assume that we're comparing to an S&P 500. So, a security with a beta over 1.0 has more risk than the market. This tells us that the market itself has a risk of 1. If we are looking at the S&P 500, we would assume that's our measure of 1. That's kind of equilibrium. That is market risk. So a security with a beta under 1.0 has less risk than the market. And when we say risk, really what we mean is volatility. So risk in terms of systematic risk is just volatility, movement up and down. We're talking about unsystematic risk. That's a different conversation that we've already had, that diversification speaks to. But when we talk about risk in these areas, what we're talking about is simply market risk, the volatility of an asset, or systematic risk. So a lot of us things refer to the same thing, but I'm just going to say risk for pronoun, and remember that's what I'm finally getting. Feeling okay, good. I didn't get my head wrapped around, but that last thing was on. Okay, well, hopefully there'll be a little bit more to look at here. I am not expecting you to understand the calculations at all. I don't understand half the calculations. I still use these things. So it's okay to not completely understand the exact way that these things are calculated, but I figured I'd give you the information anyway, just so you can see what it's from. So the calculation of beta works as where basically what you're looking at is the variance of returns in a general sense in the market, as well as this, the variance of the returns of the individual stock. Really what it ends up coming down to is when you're looking at the variance of returns between the two things and how they relate to each other. If they are similar, as one goes up, if the beta is higher, then the stock we're comparing should be traveling further upwards, but if its beta is lower, it should be traveling further downwards. So a lot of this is just, if you really want to figure this out, go to Investopedia.com and look up beta, and it will explain it much better than I ever could. So the next one that we're going to look at is alpha. And the reason I do alpha next, you might think, why not do it in alphabetical order? Because alpha uses beta. So I'll explain what that means in just a second. So alpha refers to excess returns on an investment above the benchmark return when adjusted for risk. So when we look at the calculation for this, it'll become much more apparent. This is a much simpler calculation than beta is. And I'll actually describe this chip. Now, it uses beta as a gauge of risk. So when alpha calculates how much return you're earning for the risk you're taking, the risk you're taking is measured by beta. So it's saying that beta, it's assuming that beta is the correct measurement of risk. And I'll talk a little bit about what is the correct measurement of risk once we do this. So it uses beta as a gauge of risk, as our measurement of risk, how much return we should get from our security. So again, that beta is what's determining how much risk are we taking and how much return should we be seeing. Because if we have a beta of 1.5 and the market goes up 10%, we should see a return of 15%. That should theoretically be how it works in most average scenarios. Obviously, there is outliers, as there always are, but that's what we should be expecting on a normal basis. The returns above and beyond the expected amount for our given risk, for our beta, are what are expressed as alpha. Alpha is generally viewed as the value a portfolio manager adds to or subtracts from the fund's return. So, with that kind of end statement, this is kind of what I want you to focus on the most, is the value that is added, because alpha can be both a positive and a negative number. If alpha is a positive number, what that means is, if my beta is 1.5 and the stock market goes up 10%, and then I earn 17, 1.5 is what was expected. I was expected to earn that, or my 15% is what I was expected to earn. But that extra 2% is something that I did not expect to earn, and is extra given for the amount of risk that I took. So I actually earned more return than I expected to see based on the given level of risk. This is not something that you should be necessarily biasing all of your returns for, because alpha can be kind of skewed measurement at times. When you have outlier years, when you have outlier performances, alpha can get it can look really, really, really good. And if you back up over time frames, it starts to look worse and worse because consistency is just sending up there. So alpha is not exactly a perfect measurement, but it can give you some idea of whether your portfolio is doing about as good as we expect it to be, better than we expect it to be, or if you're strongly negative alpha, there's something really wrong with your portfolio, or just what you're in happens to be performing poor intentionally. So in terms of the calculation for this, when we're looking at alpha, how it's calculated, and don't worry about memorizing this calculation, because this is just here to help you understand it and how it can be useful. So if we're looking at alpha, essentially what you're taking is our return, my portfolio or stock or individual security return, and then we're subtracting from that, I'll complicate a bit here, the risk-free rate plus beta times the return of the market minus the risk-free rate. So you're basically saying, so the market went up 10%, but I could earn 5% for no risk. Okay, so that's that 5%. Multiply that by your beta, which is how much risk you're taking, how much magnitude of risk you're taking, and then that gives you what is called the beta times market premium. Then you add back the risk-free rate, and then that gives you how much that is expected to return. Basically, the whole thing in the brackets right here is how much you should actually be expecting to return based on your beta. Then you subtract that from your return, and that's your expected return out from what you actually got. And if there's something over and above, that is what is more than expected. Well, that is basically what would be our extra free returns. So when I say risk-free rate, what are we talking about? Because we don't really talk about risk-free a lot in the industry. We don't talk about guarantees unless it's with insurance sales. But that's a conversation for a different day. The risk-free rate refers to a theoretical rate of return of an investment with zero risk. Obviously, that doesn't really exist. That's not really out there. But you can represent it with the closest thing. So generally what we're using in broad conversation in industry is a 3-month US Treasury bill. That's the closest thing we got to a no-risk investment. where you're still earning a decent amount of interest. So if you're looking at these 3-month treasury bills, nowadays probably, a few percent, not for 3 months per year, you split up, but we would assume probably something between 3 and 5% these days, and biasing towards that higher amount. But alpha accounts for the risk taken, so remember that's our beta, as well as the return that could be made by taking the zero risk, which is our risk-free rate, giving a truer measure of excess returns, and simply comparing nominal returns of assets versus their benchmark. Now, what do I mean by the stocks part? By nominal, I just mean like what is measurable. So if I'm looking at a growth fund that, so let's say it has a 2.0 beta, but we're not thinking about that right now. I have a growth fund and I see it returned 15, market returned 10. We go, oh, probably earned some alpha on that, right? Because I earned more than the market. But if you were to take into account the risk that you took for it, if your beta was double that of the market, the fact that you earned less than double the market when accounting for that means that you didn't actually earn any alpha. Now, obviously, it's not as simple of a calculation as I'm saying, because you can see that right here, but it gets pretty close to the idea. So alpha is just a way to measure, based on the risk I'm taking, based on what you could get in a treasury bill, how much extra am I getting out of this? You shouldn't be expecting to get extra out of every investment, but if you do, it's a reason to be happy. So the next thing that we're going to look at is something called R squared, something that I mentioned as we began. R squared is one that I find it's difficult to explain the difference between this and betas to people sometimes, because they sound really, really similar. So what is R squared? R squared is the percentage of a fund or securities price movements that can be explained by movements in a benchmark index. Now that just sounds like I'm using different words to say the same thing, but I promise it is actually different. It sounds like relative risk. It sounds like, well, if I have R squared of 80%, it means I should have about 80% in return to the market. Kind of, but not really. Really what R squared is saying is how much of the returns that I'm seeing can be explained by things that happen in the benchmark. Because if I'm simply looking at beta, I might be in an investment that travels in a completely different direction as the S&P 500. And so if I'm looking at something like, for example, real estate, we'll look at examples. If I'm looking at real estate, that doesn't really travel in the exact same direction as the stock market. In fact, it can travel quite the opposite sometimes. But I might see, some good returns on that, different from my stock here. But that doesn't mean your beta could show different measurement. Your beta could be high, it could be low. But the R squared, what that's talking about is how much of the movement can be explained by the benchmark. So if we're comparing our real estate to the stock market, we might say only like 50% of that is explaining what's happening in our real estate investment. All the stuff that's happening in the stock market, maybe not all of that is really causing the movements here. So it's a little bit more complex of a way to measure relative movements, but it's really more about, instead of the move, it's really how similarly movements are. So I'll show you what I'm going to have to say. Wait for some things.
All these relate just to the stocks or also mutual funds?
Also mutual funds. Yeah, because the way that they will apply to the stock, it will apply to all of them sort of together. Because we can also do this with a portfolio. So we'll talk about that ongoing. So we can use this number to gauge how similar our investments are to the comparable index. This can be particularly useful in determining if there is value high fee funds that invest in the common sector of the market. Like I was just explaining, again, I'll run through the example again. If we have our S&P 500 funds, in that accounting that I was looking at, where you're paying 50 basis points versus where you could be paying 5 or 10, okay? The R squared between those two investments is going to be 100% because they're the same thing. All returns in one will explain all returns in the other. So why would I pay an extra fee for things that are exactly the same? So if you're looking at an equity fund, let's say I'm looking at a managed fund from something like Vanguard or American Funds or Franklin, it doesn't matter what the name is. Let's just say they're picking stocks and trying to be a growth fund. Now, if I look at that and I use the S&P as a comparison, and I see that my R squared is something like 97%. 97% of my returns can be explained by what happens in the S&P 500. And if my risk level is similar, and I'm earning similar returns, but I'm paying them 1% a year, I don't care what it is they're doing. It's giving me the same dang thing as I would be getting in the S&P 500. And I can see that based on R squared being incredibly high and based on my returns being relatively similar. So if you have really high R squared, it's not necessarily a bad thing. It just means that whatever you're comparing to, you are performing or moving in a very similar way as that particular thing. So if you're paying a big fee for something with a high R squared, I just want to know why. What could I possibly be receiving for that extra fee? And obviously it's explained in percentage-wise. So if you're at 100%, it means that all the movements in what you're looking at can be explained by what's happening in the index. If it's 0, it means literally nothing that's happening in the index can explain anything at all into my investment. So something that might be really, really close to 0 would be if I were to compare the stock market versus the big one. There's probably not very much of an explanation there because the stock market, that's almost not on this particular currency. So when we're looking at the R squared calculation, it's kind of simple, but it's really more complicated than this. I just pulled the simple explanation from the best idiot. So it's just looking at all of the different variation of returns, the different ways that they go, and then also the unexplained variation. So kind of like what is not overlapped between the two things, because what we're doing is we're basically taking all returns from all time frames, all the data we have, and comparing it. And so everything that is pretty much the same that can be explained by the index, we'll remove that out, and we're left with unexplained variation. Divide that by the total amount of variation, and then subtract that. Once it gives us some percentage, or it gives us like a decimal, it's two percentages, but so beta in practice. Now that we kind of know what beta is, how we got to calculating it, what it represents, really how it works for us, we'll remind you of a couple different things. The market or the benchmark, where it is it's in place, again, we're assuming the S&P 500 has a beta of 1.0. The measurement of beta represents the approximate relative risk of an asset portfolio. So remember that all of this is relative to what we're comparing to. How much risk am I taking on compared to that segment there? Am I taking half the risk of the S&P 500? Am I taking 80% of the risk of the S&P 500? Am I taking more risk than the S&P 500? This is what we use to measure how much risk you're taking relative to that. Beta 1.0 or beta higher than 1.0 is more risky. Beta lower than 1.0 is less risky. Yeah, it's just my market risk if it sets. So if we look at some charts, what I have up here is I have the S&P 500 index, and I also have fund the VTI from Vanguard, which I believe is a Vanguard Total Market Index fund. And if you'll notice, the lines pretty much overlap completely. You can see that as we move up basically the same. As we move down basically the same. And there's almost no area except for right here where they deviate from each other. They're very, very similar. And they're very, they move in very similar directions. So if you had to take a guess, what kind of beta do you think this fund would have when comparing to the S&P? You'll look close to 1. Close to 1. And you're exactly right, because you can see that as much as we move down in the S&P, that's about how much we move down in the total market. As we move up in the S&P, that's about how much we move up in the total market fund. So you can see that these total market funds in the S&P have very, very high correlation in terms of their beta, their rates. It wouldn't really matter which one you take. If one goes up 10%, the other one's probably going to go up 10, and same thing other way around. So then if we look at something like this, now we have the S&P. The S&P is the dark line. Then we have the ticker VUG, which is Vanguard's growth fund. And you can see much stronger deviations in price. You can see that as we go upwards, this fund skyrockets all the way up here to the incredible percentages. But you can also see that as this bit dips, we did really strong into that same area. So are there any ideas of what the beta might be on this one?
A long one, 3.
Yeah, it could be 1.3, it could be 1.5, something above the 1.0, because we're seeing greater risk, especially can be explained if you look pretty much at this area right here. You can see that as the S&P starts to, not lazily, but a little less generously run towards the top, growth fund just absolutely explodes. And as the S&P sees a pretty decent retracement, but nothing really out of anything that we've seen before. We've seen these, but as that starts to trace down, the growth fund just absolutely tanks because we're taking so much more relative risk. We feel it both ways, not just up, but also down. So if you were to have thought both of these funds right here, the S&P would show a much smaller loss than this growth fund, because it's not taking as much risk. Now we can look over here. So now we've got VTV, which I believe is a more value-focused fund, and then again our S&P 500. Now this should be pretty easy. What would we expect the beta of this to be? On year one, we would expect this to be closer to a 0.7, 0.8. I think I remember it being around 0.8, but it was. So you can see that as we run higher, we don't have as strong hills upward, and as we crash low here, we don't dip that far. Sure, we did down a little bit, but it's not quite as drastic of a fall as the S&P 500. So that gives us an idea of what beta actually looks like over the long term, and what it's actually going to mean for the investments work over. So if you're looking for something that gives you a lot of growth potential, you might want a high beta, because you might want that long-term chart to go much higher than S&P. But you also have to be ready for, if this happens, if you see that drop, you've got to be ready for that to happen. And that's why you wouldn't want to have a high beta investment for something you're looking to cash out soon. Next, we'll look at alpha in practice. And again, I just want to stress that alpha is not something you should be optimizing for. That's for a portfolio manager to do. That's not something we don't mess with too much, because they'll end up taking extra risk. And probably a lot of people who try to make alpha lose a lot of alpha. So it's a very, very hard job. There's a reason that this is what investment bankers do. It's the reason that fund managers are the ones that do this. And it just simply is very difficult for us to do as individuals to deal with that. So alpha measures the excess return of an investment or portfolio relative to its expected returns given its level of risk. Remember, level of risk being beta, expected returns basically being the market premium added on to the market premium multiplied by the beta added back to the risk-free rate. But we don't care about that. Just what are we expecting to see? How much more we get? The fund or portfolio's returns, it currently fund is the fund or portfolio's returns, its beta, market's return, as well as the risk-free rate are all used in alpha's calculation, which is what we showed earlier. All of those different data points get put into that equation. Riskier an asset is, the greater returns it will need to generate in order to produce alpha. So obviously, the riskier that we are, the higher our beta is, the higher actual percentage returns we would need to see in order for it to be considered alpha. Because if we have a 3.0 beta and the market goes up 10%, 30% would just be what's expected. That would just be what we'd be looking for. So we would need to be generating 40 or 50% to even start considering it as alpha. 30% is what we would be expecting. Index funds generally don't have alpha. Generally, they don't have alpha. Generally, it's a safe return just in case there's one out there that does, but they don't have alpha because they're measuring against the index. That's what they're basing the risk on. So if my risk is the same as the index I'm looking at, why would I expect to see the alpha? If you have a lot of index funds in your portfolio, like we tend to recommend and we tend to practice, alpha is not going to be the thing that you're looking for. Alpha is not going to be the performance metric that carries you forward. Generally, the time that you're going to see alpha is when you have other things like sector funds or maybe some really aggressive growth funds or individual stocks that add extra returns on top of what you were already expecting. Index funds. When those produce tons of returns and give us all this extra money to play with, that generally is what's going to contribute to our alpha. That's what we see. So if we happen to pick a sector, buy it at the bottom, and then it grows really high, next time I pull up the portfolio reports, it's going to show some alpha because utilities just gave us 300% or whatever the ridiculous number was. Question? Yeah. If you had two identical index funds, same expense ratio, but one of them borrowed money to buy 4 of the indices, they would be similar alpha, but their betas would be different? Yeah. Yes. Because what happens is you end up taking more risk, but you'll get the same return, not the same return, but you'll get the same level of return if I buy that thing of it. So if I were saying they have an index fund that just a normal index fund, all we did was buy S&P, and then we've got a leverage fund that, let's say the product existed somehow that you just got 2 times the S&P, it wasn't any complicated futures derivative, it just was double it, and you could just invest in that. Because that fund would have double the beta, it would need to return more than double the returns for it to be considered alpha. So a 20% return here and a 10% return here would be considered equivalent because you're taking double the risk to get that double return. So you have to be producing more than the index, which the index fund would possibly in order to generate alpha. So the greater beta would be because you're buying and taking more risk. You're borrowing and taking more risk. It would be because you're taking more risk. Yes, borrowing. However, that would not necessarily borrowing. That's how many risks. Well, but if you had twice as much money there, you would get the same return, same alpha, just be a bigger figure as the other one small. Right. Exactly. So that's what I'm saying. The beta gives you that you're taking on more risk. So because you're taking on more risk, you'll get more return. Yeah. But that's not extra because you took the extra risk to get that here. So there's no alpha to the gap. You have to watch out for chasing alpha too, because somebody might say, hey, our fund's up greater than theirs, but whatever they did in the past may not be repeated in the future. So back in the 80s and 90s, you saw Money Magazine, all these Janus funds, we have so much alpha, we beat everybody, but they took a position that other people didn't take, and if it paid off, the level of risk and everything, it may have looked really good one year, but if you chase alpha, it may not repeat itself. Last year, you might have had a lot of growth funds in it that maybe your alpha performance of your portfolio is really good, but maybe next year they have been something wrong. Right. So people that will generally be most concerned with alpha, hedge fund managers, most of the people that talk about alpha all the time are creating alpha by taking risk, and if they're lucky, they just run. Right, exactly. And that's how they generally, like that's how they measure against each other. So how much extra return can I get for the same level of risk that I take on? Because if you're given, let's just say, for example, let's say I was a trader and I got a proprietary plus hedge fund, and I was told that I could risk a certain percentage of assets every single trading day or trading week, whatever it is. Whenever I go into that trade, I go, okay, I need to take the same level of risk, stop and loss at the same level, but I want to make sure that whatever it is I'm getting into has a much bigger payoff. If I'm able to make 5x what the next guy makes, that's my alpha. I'm generating more return based on the same level of given risk as the guy next to me. So that's when alpha really starts to come into play, when you get to those really aggressive and professional traders here. So alpha is not something we like to chase. Something that we like to chase is the right portfolio, the right risk tolerance, and making sure that you're not taking extra risk, you're not taking little risk. You're just simply doing what actually makes you feel comfortable in your investment. So don't chase alpha, don't chase. Really. You just want the right thing for you. So R-squared practice, we talked a little bit about how this could work. R-squared can tell you how similar an investment or portfolio's movements are to a given index. it's like, I know that I keep saying like, if you're really high, R squared, you should be making sure that your fees aren't super high. I'm gonna let you know right now, your portfolios are almost always gonna have a high R squared because there's gonna be a lot of index funds, there's gonna be a lot of funds that have overlap, and you're gonna be similar to the market because that's what we do. That's like our whole thing. We want to participate in the market, make sure our risk is controlled. And so your R squared would generally be in what is considered strong. So in finance, the R squared of 70 is considered strong. R squared is actually not just a finance term. It's actually used in regular statistics all the time because what it is the term R squared comes from the fact that you're basically multiplying correlation times itself. And now that's what it's occurred. So if you're looking at two things and how correlated they are, you then multiply the correlation times itself. That's R squared. That's complicated. Don't worry about it. Just know that R squared above 70 is generally considered strong. What means you are pretty similar to it. So we would expect index fund to have a really high R squared. We would expect like a plus if there's anything other than that. Is this really an index fund? What's going on? The only reason that an index fund will not have an R squared of 100%, reasons, two things. First is the fee, okay? It's not going to be perfect because there's a little bit of fee taken out, and because that fee is a flat amount, it's not like it adjusts with performance. That's going to take a tiny bit away from your R squared and stuff to beta. And the other thing that will take a tiny bit away from your R squared, okay, is the cash that money is worth. Generally, funds are not 100% invested. Usually below some cash, especially mutual funds, when they need to redeem people out of the investments. So sometimes an index fund, or really any other fund, might have a little teeny tiny bit of cash set aside for miscellaneous reasons, for expense reasons, or a multitude of different reasons. But an index fund is generally going to have a really high R squared. It's going to be very similar to whatever it is that we're comparing to, and that's perfectly okay as long as it's a low fee and not like 54 basis points like I was talking about. So when we start looking at R squared in practice, we go back to some of your charts that we were looking at before. So now we're looking at the same thing that we looked at before initially, which is the S&P 500, which is the purple line, and the Vanguard Total Market Index, which is the orange line. Based on what we've talked about, we got any guesses of what the R squared probably is for this one? Eric, you guess if Jake said that the guess and how he's sending me on for this song. It's going to be almost 100. Because if you look at the overlap, again, like we said before when we were talking about beta, it's almost the same freaking thing. Like we're almost looking at the same investment kit. So we would expect our R squared to be very high. Now you can see that it's not 100 based on Securities right here, where you notice that the returns are just a little bit different sometimes. Sometimes they start running in slightly different directions, but for the most part, pretty much all the movements in this total market fund can be explained by the movements in S&P 500. And that really kind of speaks to how the biggest companies on the stock market dominate the direction it goes. It really is what is shown here because you're using those top 500 companies versus the total market. You'd expect the total market fund to be a little bit more different because of how much those top players dominate the equity market. You can see the results of that by your own chart. So if I move forward to something like the VNQ, for example, which I believe this is a real estate fund from Vanguard. Now, you can see that there is some similarity in the way you charts. But then you can start seeing some differences in an area like this. You can start seeing some differences here, like this one, sharp upward move, kind of trade sideways. And then yes, we fall at the same time, but as the S&P starts to come up, really flattening out, it's still falling off. And it's just a little different over here. You can see we actually start dropping off while the S&P dies. So based on what we've talked about, what would you expect the R squared or something like this to be in generalities? Something around, yeah, about 50% is what the R squared is something. So you can see how those measurements affect what returns look like. Obviously, the magnitude of the returns is also different, but that's not what we're worried about right now. We're worried about the similarities. So you can see that, yeah, while we are still having some similar returns, we have areas that they're not similar at all, or that they're just entirely different. So that's what R squared can tell us. So if you're looking for something that's different than what's in your portfolio, and your portfolio has a really high R squared, look for some funds that maybe have some low R squared. Maybe it'll give you just simply different returns. It's not saying that it will necessarily be better or make you more conservative, but it gives you really diversification in your life.
So does that help you do negative and correlation, like negative
Yes.
correlation, non-correlation?
Yes, because if you remember what I just spoke about just before when we were talking about R squared, if you remember that R squared is pretty much if you take correlation and multiply it by itself, that then speaks to, yes, because of R squared as the measurement, is basically representing correlation. So a lower correlation basically shows you that, or lower R squared shows that you have lower correlation between these different things. Now, obviously, R squared can't really help you with defining negative correlation, because each square averages becomes a positive. That doesn't really give us any information. But it can push you in the direction of things that don't move exactly the same direction. So yes, if you are looking for assets that could be negatively correlated, or simply just very different, have a lower R squared is going to put you in that direction. And that might be a filter that you should use for your morning star. So again, here we have the same sort of thing. This was EDE, this was energy. I mean, you already guessed the last one, so I'll let us know. The R squared of this is pretty low. You can see that as the stock market chases higher, we just going absolutely that. I mean, the time in this fund dropped pretty strong in 2020, all the way down to, he doesn't remember, she was at the price and stuff like that. You can see that these returns are very different, very, very different. You see all the way back here in 2011, this spiked really high and then dropped really strongly while the market itself didn't really do much at all. So again, it's another way that we can see that R squared being lower shows us that the returns are not necessarily more risky or less risky, but that they're just totally different.
So let me ask you a question, because if we look between 2011 and 14, they're pretty much following each other, and suddenly there's this big separation. Is that negative?
Negative what?
Well, why would I invest something that, if I compare it to the fund that is not going to give me the same return that the 500, am I correct?
Possibly. So really this is more of like an example piece, but when we're looking at these correlations as well, something that we can keep in mind is, let's say we're looking at a period like, I don't know, if you kind of just zoom in here, you could also say the same thing in constant bet, where you can see that the stock market begins to fall pretty drastically, but this begins to rise higher. So, well, we can use these for, it's a difficult concept to understand on its own, but when you're looking at a portfolio, sometimes what you want to do to bring returns closer to the average, to smooth them out, to not make them feel as drastic, is to add things that are less correlated. So if you have a lot of total stock market index, that's a lot of volatility for you. And you want to bring down volatility, but you don't really want to be selling out of that. You don't really want to buy bonds. So you just want to get into something that goes the other direction. What that ends up doing is when you have years of particularly poor returns, non-correlated assets have an opportunity to make that differently sided move. So if the total stock market is, for example, crashing strongly, like in I think still down 2022 level, if the stock market is crashing strongly and your total stock market holdings are falling, something like this, which is a non-correlated asset, would be moving in the opposite direction, giving you a little bit of a buffer and not making your negative returns so large. So it's really kind of just like, it's not necessarily that you're bringing down your overall level of risk, but you're making some of those more drastic years and more drastic periods feel a little bit less drastic when those uncorrelated assets do what they do in the opposite direction. So it's not necessarily giving more, or it's not giving you extra return. Yes, if you had just held all S&P in this example, you'd do far better. But again, it starts to depend on your goals, what you're trying to do. And so these non-correlated things will help us on the downside in terms of squishing that downside as small as we can for the sake of giving public autonomy. Okay?
The index funds are generally the whole economy, so they'll be better long term, but within the short term, a sector fund like oil or real estate may have a really good couple of years, while everything else, let's say the total market starts to slow down because of technology and maybe inflation heats up again, then the energy fund's going to be then for a little while, but not the whole time. So the core asset should be more total market or S&P, but during either to be non-correlated just in case something blows up on us, or at various times you could buy into a sector, let's say like energy, that you think inflation's going to heat up again. Then it might just take off for a temporary few years, get by now pace everybody else that makes sense. And all the things that Nash was talking about was coming up with common sense portfolios, but the opposite can happen tomorrow. Because the stock market's done so much better, let's say, than, well, the growth stocks have been really great for a while. But when we thought interest rates were going to go up for a while, 2 years ago, people would sell their growth stock to get a short-term return on CDs. Because growth stocks and technology is thought of as long duration. But then when we thought interest rates are coming down, guess what happened? Technology took off. Yeah.
So, moving forward, we're going to start talking about a couple other things now that are a little bit worse. Well, actually, worse than Terrell is sliding. So, we're going to start talking about some risk and return statistics. Now, these are not actually derived from modern portfolio theory, so they're not based on the exact same things, but they can give us some somewhat similar ideas, but also some more independent measurements. And you'll see what I mean in just a second. So we're starting with standard deviation. Standard deviation measures the dispersion of a data set relative to its mean. What is that? If you have an average number, if you have, say, an average return of 8%, you have a standard deviation of 10. You would say that within normal, so each level of standard deviation has a probability that returns will fall into it. So if you look at 3 standard deviations, if I have a return of 10%, let's say I have a standard deviation of 10, just to make the numbers short. Let me see. With 1 standard deviation, we would expect the returns could drop all the way to 0, or they could bump all the way up to 20. Based on 2 standard deviations, it could go all the way down to -10, or it could go all the way up to 30. And so with each level of standard deviation is when you capture probabilistically all the returns. Within 3 standard deviations, so 3 measurements of a standard deviation, 96% plus of returns are expected to fall in there. And when you go down to maybe 1 standard deviation, you get something like 50 or 70% or something like that. But the most important thing is that standard deviation, it just measures how far away do we travel from what is the average measurement. So if I have an average return measurement, how far are we likely to travel in any regular year? Usually is the standard deviation of the fund or stock or portfolio or whatever it is. So this measurement gives us an idea of overall volatility of any given investment. It doesn't give us an idea of relative volatility compared to anything else. It just is simply looking at all of the information for this particular thing. How far do we tend to stray up and down from the average measurement? So returns may fall within or outside of this either range, because these things are kind of just general measurements, they're general ideas of what is considered standard, again, standard deviation. Returns could be way higher or they could be way lower, but for the most part, based on historical data, this is where we expect them to be. So we kind of use it as a way to give us an idea of what it might do, what it is no measurement of a guarantee, and it's not saying that we have to stay within these lines. It's really just based on everything we've seen, this is where we expect it to fall on any given day.
For a fund, it could be like taking the temperature. If you take somebody's temperature and it's fine, we know something's going on in your body. If we find a bond fund that standard deviation is really high compared to others, what's going on here? Do you have junk bonds, or are you borrowing, or are you doing things? So he'll keep an eye on an average standard deviation, and if something has a greater deviation, that's okay if that's what he wants, but something's going on to make that higher than normal.
So when we're looking at a standard deviation, here is a graph. Get it? In basically any math class, you will have seen this in statistics. This will be familiar to you, but this is what a standard deviation graph looks like. Generally, most things fall in this area here, which is what I refer to as one standard deviation. This is the single part. It's kind of like a little coat of the hairstyle on some gel before it was on it. But this is where most of your returns tend to lie. So that's about 68, almost 70% of those returns tend to be within here. And then as we move further out, even more returns are expected to be contained in here. And then as we move even further out, we see that pretty much everything should remain within 3 standard deviations. That's when you get 99% plus of all returns should stay within 3 standard deviations. I think it's 96 within 2, and then 70 within 1. So really, it's just saying this is all of the information that we have, and we can see that this is generally where all of that data tends to provide. So when we put that into practice, again, it shows us overall volatility, both good and bad, for any given fund or portfolio. At least it measures movements up and it measures movements down. It's not discriminatory against either. It's everything all together. More volatile investments have a higher standard deviation. More stable investments have a lower standard deviation. And you can have a low standard deviation on something that returns 5% or 0% or 10%. All that means for it to have a low standard deviation is that you don't see wildly different returns from year to year. So standard deviation is not necessarily telling you that you're going to earn a lot or you're going to earn little, but it's telling you how far from what is typically expected from this can I expect to go on any given year. We can use a target standard deviation to keep our portfolio in line with our risk tolerance. So one thing that helps us is when we are talking to a client, one of the things that we do is what's called a client profile. And we ask them, have them fill out a little risk tolerance questionnaire, kind of, poke it in a little bit, and try to get an idea of how they feel about winning or losing money, and how they would feel if they saw a particular year where their investment portfolio went down to, say, $10,000 to $15,000, how they would feel. So if they say that, oh man, I would really just absolutely hate it if I lost 10%, that would absolutely freak me out. I would not be able to handle it, and there's just no way that I would be able to be emotionally stable. I would go, okay, great, that's great. Now I know to reel in standard deviation, keep us at a level that if we start to vary out from our expected average, it's not going to put the client in a place of panic. Or if we're doing goals-based, if we're basing it on the achievement of a goal, I want to push standard deviation into an area where I know that there's a really high percentage of us hitting our goal and not stretching ourselves too far so that we have really wide-ranging returns. We want to actually lower our cognitive state. So I want to keep us sort of like in a nice channel that goes relatively upwards, even though we might go up to the top of the channel or down to the bottom, and have a back and forth in between there. It's like keeping a nice channel of just upward trending over time with our investments. And how wide or how short, how small, narrow you want that channel to be is what standard deviation causes us to make. Standard deviation is one of those ones where, like, it's really simple, but to understand it fully is really complicated. So it's just one of those things where I would just look at it, when you're thinking about standard deviation, think about how far from the average can you go. That's what it's doing. So when we talk about that average, what we're referring to is what's called mean return. Mean return is exactly what it sounds like if you know what those words mean. It's just taking all the returns that we've seen and calculating a normal average of those. It's very simple. It's just like expected value or beat all the likely returns of investments comprising the portfolio. So generally what we're doing is we're looking backwards at all the data, getting all that average, and then kind of pushing that forward as what we would expect the return to be. So this is established by simply taking the mean or the average of all historical return data, whether that be by day, month, year, whatever the software is using as a period to calculate it. We're just adding all those data points and dividing by how many there are to see what is the average receipt per year on top of the quarter. So outliers can significantly skew the mean return, especially if the data set is small. And if I say something like the data set is small, you might think of a brand new fund. If I have a brand new managed fund that's only been around for 2 years, and one of those years was really, really good because they happened to buy a Tesla right before it exploded, capitalist, that might look really good. You might have a really high mean return, a really high expected return. Then you go forward, and as Tesla starts to lag, Elon Musk does some weird stuff, says some things, goes on the Joe Rogan podcast, buys Twitter, that starts to lag. Then the performance of the fund just starts to fall off the cliff and does not represent that mean return at all. So if you don't have a lot of data, this means almost nothing. And it means almost nothing anyway, because an average is simply an average of what has happened. It is no predictor of the future. It can be maybe what we expect, and what it is most useful for is what we can expect over the same period of time that we've measured backwards. So if I measure backwards over 10 years, I see it's returned 3% every year for 10 years. I could be realistically thinking that over the next 10 years, it looks like 3% a year, but next year it could be 10%. The year after that could be negative 20%. The year after that could be 30%. But as long as it averages out to 3% a year, then it's still within the range of what I'm looking for. So in practice, the expected average return is based on historical data. That's just the mean returns data. It's not a guarantee of future returns like I've been saying, but it is the basis from where we measure standard deviations. So if I want to know, you might think of standard deviation. If somebody explains it to you without explaining the return, you might think of it as like, well, if I have a standard deviation of 20, that means I can gain or lose 20%, right? That's kind of what it sounds like at first. But when you take into account mean return, what standard deviation is saying, how far on average do we go away from the mean return? So if my mean return is, again, something like 5%, but I have a 10% standard deviation, a normal year would be gaining 15 all the way down to losing 5, and all of that to be within one standard deviation of the mean return of that. And so, lastly, out of these, one thing to talk about is Sharpe ratio. Sharpe ratio is interesting. It's almost like alpha. It's really close to alpha, but it's not quite alpha. So where alpha uses beta to kind of measure how much you should return in comparison to something else, what Sharpe ratio is doing is measuring how much more you're returning based on the standard deviation of what it is you're in. So if I have a standard deviation that is pretty low, but I earned a whole bunch this year, that would show, oh, okay, that means that my Sharpe ratio is higher because it's showing the excess return that I've gotten based on the standard deviation, but not like in comparison to anything. So it divides the portfolio's excess return by a measure of its volatility to assess risk-adjusted performance. So risk-adjusted is something that we look at all the time, and it's something that I've been explaining basically this whole class, is when you adjust for the level of risk you're taking, then how much are you getting? Like, how good are those returns in comparison to the risk you're taking? So it's similar to alpha, like I just mentioned. However, instead of using beta to calculate our measurement of risk, it uses standard deviation. Because like I mentioned, it's not a relative measure. We're not measuring this against the S&P. We're not measuring this against the bond ag. We're just measuring this against the volatility of the thing itself, based on how volatile this stock is, how much extra return have we gotten this year, based on the standard amount of volatility that we tend to see. So again, it's like if you have your standard deviation, you have outlier year, then Sharpe ratio might start to look really high if you have a standard portfolio of 10% or standard deviation of 10%, mean return of 5%. If you gain 50 this year, the Sharpe ratio is going to look really good because that's falling way outside the standard deviations, and it's much higher return than you would expect based on normal volatility that you wouldn't expect to be. So the calculation for this one is actually really simple. You just take the return of your portfolio, you subtract that risk-free rate we were talking about, 3-month treasury quote, and then you just divide that by the standard deviation of the portfolio's excess return. So of the extra return that it gained over, I believe, the risk-free rate. So it's one of the more simple calculations that we can use, but because we generally like to compare ourselves to the stock market, we like to compare it to beta. Alpha just generally is a better use of our time, but you can use Sharpe ratio for what CFP board teaches, so I'm a certified financial planning board, is beta is a useful measurement. Beta and alpha are useful measurements for diversifying portfolios or diversifying investments. If I have a lot of different things, a lot of different companies, I'm diversified. I somewhat feel like the market. I'm not feeling a lot of specific company risk or default risk or those sorts of things. I have a diversified portfolio of a lot of different stuff. That's when beta and alpha makes a lot of sense, because it makes sense to compare to something else that is also diversified, like the S&P 500 or its market index. But if I'm simply looking at a very non-diversified investment, maybe a cryptocurrency, a particular rental property or something, or anything that just is not very easily comparable to an index, that's when Sharpe ratio and standard deviation become more useful, because you can see how well you did compared to the volatility of the specific thing without needing something else to compare to. So if you're just comparing it sort of to itself in a way, you don't need that external index to use as a comparison of how much you should be looking. So to tie up, we'll talk about a couple extra things that you might see on a Morningstar report and we use all the time. And so there's a couple bond-related measures that we look at. First one being average effective maturity. So this is a weighted average of the maturities of the bonds in the portfolio or fund, considering all fixed rate mortgages, mortgage prepayments, puts, and adjustable coupons. So anything that could lengthen or shorten the maturities takes that into account, kind of calculates what the weighted average of all of that would be. So if I have a bunch of 10 years, a bunch of 5 years, 20 years, it'll account for all of that and sort of give me, based on how big each of those positions are, what's my average maturity? How long on average are my bonds lifespan? But that's not something that we look at the most. What we'll look at more is average effective duration. Duration is a complicated calculation. Believe me, I've had to do it a few times. It's not a fun problem to solve. But on a very, very simple level, what duration ends up being is a measurement of the portfolio's interest rate sensitivity, whereas funds interest rate sensitivity. The larger or longer that a fund's duration is, the more sensitive the portfolio is to shifts in interest rates. Now, I don't know how it happened to be this way, but it just so happens that when you look at duration, the way that you can calculate it is think for every 1% move or 1% change in interest rates, that is how far up or down duration relatively. So if I have a 3 duration, if interest rates were to drop by 1%, my bonds should go up about 3%. Because essentially what's happening is we're seeing sensitivity to the interest rate changes, giant shift in values of bonds, interest rates starting to tighten fast. Because these bonds that lasted for a really long time might have only paid 2%, 3%, 4%, but now you were getting like 52-week T-bills that were paying 5%. So why would you ever get locked into 30 years at 2% when you could just keep rolling 1 years over and over? So then these 30-year bonds fell to the floor because they had basically no value. They paid basically no interest. There was almost no reason to be in them other than to just lock your money in, I guess. So the prices dropped in order to an amount to where somebody in the free market who wants to purchase that bond, it would end up being equivalent as if they were earning a 5% interest rate on it. So if you were trying to sell those bonds, you'd have to sell them at a discount because nobody's going to buy your bond to get 2% and they could get 5, which is what they get size. So the other way I like to kind of think about duration is how long do I have to wait until the bond has basically paid for itself with the interest it's giving me? Because by the time you get to the end of the duration, that's when you've been paid enough interest that if you sold it for a discount, it probably wouldn't get on that. Duration generally, pretty much always, is lower than maturity. Because one of the things that goes into calculating duration is the coupon of the bond. So the higher interest rate that a bond has, the lower duration it will actually have relative to maturity because it's paying so much more interest, so that if interest rates were to rise, there's a lot more to catch up before it becomes a worthwhile bond. So duration, again, the most simple way to understand it is measurement of interest rate sensitivity. If interest rates go up 1%, duration is how much money will go down. Down, duration is how much money will go up.
If you ever see a chart on Vanguard's extended term treasuries, long-term treasuries, mutual fund, you'll see a couple of years ago, 2022 or so, it dropped 40%. It was paying maybe 2, and then new bonds were paying 4, and so it dropped 40%. That was quite a lot, and it hasn't recovered on that. However, if you think interest rates aren't going to keep going up, some people might lock in that 4 or 4.5%. If rates fall, then you'll either make money or lock it in. But it's shocking, and a lot of portfolios we see that people either made a mistake with or had an advisor do is they had long-term bonds in the portfolio before interest rates went up, and they lost 20 to 40% on the bonds. And that's tragic because maybe going forward, if that's all you have is money in bonds, you can go longer-term bonds to get a higher yield, but the longer-term bonds are higher than the short-term. We have a reverse, what's that called? Reverse inversion or something. Short-term is higher than
Oh, yeah.
inverted yield thing. So, but that if I only had $1 million and no other money, I might be willing to lock it in longer-term treasuries to protect that. Because if rates fall, I could get less. But most of us, we don't encourage long-term bonds. Other than, who would have bought long-term bonds when they were paying 2%? Some of you government analysts here. The government had to buy them because they had to lock in future retirement plans, right? So insurance companies and government plans that have to fund pension plans, they had to keep buying the long-term bonds no matter what because they had the long-term longer payments. Because I was wondering, why would anybody buy these at this low yield? At one conference, they said because the governments have to fund their future retirement plan to go some rich bonds.
Right, so a couple more, one few things that we'll look at today. Something that we've referenced a couple times before that we haven't really dug into is credit rating. So credit rating is independent assessment of a company or government entity's creditworthiness with respect to a particular debt or financial obligation. So these aren't like a general measurement of the entire company. It's more about the specific product that's being offered. So if you have, say, a secured debt on some kind of equipment or a building, that's going to be rated higher because it's secured by something than just an unsecured on cash. So when we're talking about credit rating, there's 3 different main rating agencies that we generally use, which would be Moody's, S&P, and Fitch. They have pretty similar rating scales, and these are what we use to sort of determine. You'll mostly hear, I don't usually hear the pluses or the minuses or the 3. It's usually just the letters on the C and charts with Morningstar. But you can see that as we start from the top, we start all the way at triple A, which is what we would consider our prime companies. Things that are where you have absolutely no expectation that we're going to default on grant. Like these companies are incredible, or mostly that's going to be your government securities. So regardless of what you think about the government, pretty much all government securities at a higher level are considered prime guaranteed debt. And as we start to move down, you'll see something like high grades or double A's. And then we get down to upper medium grade, which is single A. So these are all just slight measurement differences of the creditworthiness based on the actual debt instrument. And then we get down to triple B, which is where what's called investment grade stops. Anything above this red line is considered investment grade, which is basically considered good enough for investment, like it's actually worth putting light in. It's not high risk, it's decent return, what you're getting. You're just not, it's not a speculative investment. And as you drop below investment grade, that's when you get into what's called junk bond, or commonly a little bit more favorable name for them when you're advertising is high yield. So you get into things that are a much higher chance of defaulting on the loan, a much higher chance your loan payment not being paid, but because of that risk that you're taking, they have to pay you a much higher interest rate. It's like if I go to get a credit card and my credit score is just horrible. I've got delinquencies, I've got collections. The only thing I might be able to get is a secured loan. And even if I do get an unsecured loan, I'm going to be down here and I'm going to have to pay like 30-35% interest rates, which is like ridiculous because it's just a higher risk to look me behind me. But as my creditworthiness increases and as I move up the ladder, it gets cheaper and cheaper for me to borrow money because there's an expectation that I'm going to pay it back. There's an expectation that I will pay it back with interest on time, every time. So that's why as we get higher up the ladder, they pay less and less interest because there's a higher and higher chance that you will in fact get your money back. But really, anything above here is not necessarily a big default risk. There just is some default risk that you get charged or counterparting. But if you were somebody who was looking to get a little speculative, wants to get a lot of interest, and maybe use it as a payment capital appreciation opportunity, junk bonds might be interesting. Or maybe it's a company that we know is good, but for some reason doesn't have good credit rating, whatever the case may be. Investment grade, junk bonds. That's just the way you can do it. So, additional couple things that we could look at. These last two things here. First is 12-month yield, which is the sum of all the income distributions from the previous 12 months divided by the last month's ending net asset value, which is just saying what percentage of the portfolio was distributed out to me in income. So income refers to interest payments on debts, so that could be loans, and dividend payments from equity. So you can have something like a really big stock, some kind of big dividend paying, something like that. Some big blue chip that you withdraw that pays dividends to their investors regularly. So those dividend payments as well as those interest payments combined, that's referred to as income in general. So if you're looking at a statement, for example, and you see income and expenses, that's going to be basically all of your interest, dividends, and then obviously your expenses will be insurance fees, management fees, that's what. Potential capital gains exposure is interesting. This is what we look at when we're looking especially at non-qualified insurance. Potential capital gains exposure usually is more important with mutual funds, like we have discussed a few times before, but it can be in ETFs, just not in these commodities. So what potential capital gains exposure does is it tries to estimate the percent of a fund's assets that have unrealized gains. It doesn't give you a dollar amount, it doesn't give you an expected amount of change to taxable gain years, but it looks at within the fund's holdings how much of the stuff that they have is sitting at a gain right now. So if they say bought Apple, Microsoft, Tesla, Tesla is the one that's up 1,000%, and it's like 50% of the portfolio, and the other ones are down, then that 50% would be our potential capital gains exposure. If they were to sell that Tesla, they would have to pass that gain out to us before they bought something else.
So that fund would keep us either in retirement plans because there's no potential capital gain, or watch out when you buy a mutual fund that has a lot of built-up capital gains, because as soon as you buy it, they can distribute that gains and you'll pay the tax on it for it. So that's why you like exchange traded funds, because they usually don't distribute that, they trade it away. Yeah, exactly.
So a negative percent indicates capital losses, which could be used to offset capital gains in future years. So what they might do is if you see a fund that has negative capital gains exposure potential, it could retain that and then apply it to next year so that it doesn't kick it on against you. So it's very similar to like the same thing you would do with your own individual account. As if you had something at a loss, you had something in the gain. So if I had a big loss here and I decided to sell those assets, hold on to that loss, next year I make a whole bunch of money, and then I apply that loss to that gain and net it out, and make it zero. That's something that these funds can also do. And this is a concern only for non-qualified or for non-qualified accounts, not at the same tax, but it's for individual accounts, trust accounts, or any other accounts that really just don't have tax benefits. If you work in an IRA or something like that, it won't really matter because everything's going to be ordinary next day. But in non-qualified accounts, these capital gains distributions can be appropriate. So, with that said, that's everything that I wanted to cover today. If there are any questions before we dive into the part of investing,